Hello, everyone, and welcome to episode 13 of the Lifespan Investment Series. Joining me once again is Lifespan Investment Committee member, author, and publisher of the Payne Report, Jonathan Payne. Good to see you again, JP.
Nice to see you, Eugene.
So let's jump straight into it, and we'll start with something that's been on a lot of advisors' minds this year. Markets, in the main, if you look at the big broad indexes, have done pretty well over the last we just talk about the last financial year. But they've thrown up a wide range of returns when you look into the different sectors, particularly if you look at how some of the active managers have performed. There's been quite a wide range of outcomes in the active management space. Jonathan, what are your thoughts on how this has come about and where active management is positioned, given the current market performance? And can you shed some light on, what some of the reasons why we've had such a wide range of outcomes with some of the different active strategies out there?
Yeah, well, thank you, Eugene, and thank you for inviting me to share our thoughts with everyone. Eugene, you know that the question you've asked me is a very, very challenging one. It's a very, very complex one, and there's really no easy answer. I agree with you. There's a massive dispersion in returns across the entire investment landscape. I think what we've witnessed, certainly since the last time we spoke at this forum, which is now 3 months ago, we've seen spectacular volatility across a range of markets. You know that in my weekly Payne report, Eugene, I've written extensively about South Korea and how we saw basically a bubble and a bubble bursting. I'm not sure. I'm sure most of the people watching this will know that the South Korean stock market fell 42.8% in 27 trading days. Now, most people might say, oh, who cares about South Korea? Well, actually, it's one of the largest stock markets in the world because of course, SK Hynix and Samsung, both which exceed $1 trillion US. So extraordinary volatility coming out of the East, particularly when it comes to or relates to the tech sector. And we then obviously have to throw in the whole universe of artificial intelligence. So within the artificial intelligence universe, we've seen extraordinary dispersions. We had the long hardware, short software trade, and then that was reversed. And the hedge funds have been super aggressive in that particular sphere. Now, emerging markets, for example, have been a real standout, very, very strong performers. I'm not quite sure what the exact 12-month numbers are, but they would have to be up 38% over the 12 months. They were higher prior to the big sell-off in South Korea. In the United States, huge dispersion within sectors. You're right. At a headline level, at a benchmark level, the S&P 500 has been relatively calm, relatively well behaved. Beneath that calm surface, we've had a frenzy of activity with extraordinary volatility. So the SOX, which of course is the Philadelphia Semiconductor Index, crashed in the month of July. At the end of July, everyone will know that we saw the spectacular demise of the hedge fund situational awareness run by, of course, Leopold. And in my report, I speculated, have we seen the Leopold low at the end of July, July the 31st? And I suggested that people buy some bombed out tech stocks. But the bottom line, a massive dispersion. Then across in Australia, which I was actually looking at some numbers this morning. I mean, Australia over the last 12 months, as of today, the 18th of August, is almost flat, which is pretty extraordinary. It might be up 0.5%, might be up 1%. And so you've got your league table, South Korea leading the way. Obviously, Europe's strong as well. The United States pretty significant as well. Quite positive returns. But beneath that headline level, we've massive volatility. But it looks like the liquidation of Leopold's hedge fund situational awareness may have marked a short-term low for some of the AI-related names. And we can develop the AI theme because I think it's just so dominant in terms of everything that's happening in the world. The bottom line for me, Eugene, and I know I've said this over decades and decades. I mean, I'm a huge advocate and believer in active strategies. I just think there is a treasure chest of opportunity for genuinely active managers in the current environment. And in my mind, what we saw from about May the 31st through to the present time is a wonderful example. And if you get the moves right, active managers will have performed incredibly well if they read that move, because what we saw, Eugene, and this is why I wrote so extensively about South Korea in my weekly pain report, and why I turned negative on May the 31st, is we saw parabolic price action in South Korea, parabolic price action,
Mm.
historic exponential increases in South Korean stocks. And I said at the time, this is not sustainable and it's going to go. And it collapsed. And we had a massive crash in South Korea. As I said, nearly 43% in 27 trading days. It's actually the fastest crash in history.
Mm.
And that then fed back into the United States. It fed back into some of the spectacular, Micron, SanDisk, the memory names. And now I think that's been flushed out. That leverage has been flushed out. We saw Leopold hedge fund blow up. And then we saw, I hope many of the people listening to this understand that Citadel effectively came in as the white knight. I wrote in my report, it's a bit like a lamb finding itself in the middle of the Masai Mara and being surrounded by hyenas and saying, please, can I have some help? That was what Leopold was like, being surrounded by ravenous hedge funds, who obviously took advantage of Leopold's demise. But anyway, it's one for the record books, and I can't wait for the film.
Indeed. So to try to bring that together, is it fair to say that a lot of the stronger performers were companies piggybacking off the back of this incredible AI boom that we're seeing, the so-called picks and shovels companies,
Yeah,
names like Nvidia, TSMC, to name a
yeah,
few, and there's
yeah.
many more. And a lot of the stronger performers have been in that space, but there's been enormous volatility across a lot of the rest of the market. Um, the other thing I would say to that is that one of the reasons active managers perhaps in some spaces have struggled, and this is perhaps a hypothesis to you, Jonathan, they've struggled because these companies have formed such a big component of the indexes that some active managers have cautiously tried to diversify away a little bit from some of them. Most of them will still have a significant exposure, but perhaps in trying to diversify away a little bit too early, some of them have underperformed. Some have taken much bigger bets against. So, is that? Would you say that's a fair observation?
Yeah, it's an interesting one. I mean, that I think is a fair observation, but as you know, it's really, really complicated
Yeah,
beneath the surface. So within the so-called AI universe, companies, okay, and you correctly, I think, identified names like Nvidia and obviously TSMC that are the quintessential
yeah,
picks and shovels. So what we've all been trying to do for a number of years now is identify the principal beneficiaries of this huge spending on
mm,
building what we could call this giant brain, because artificial intelligence is a giant brain, and we've never seen anything like it. And we know the capex numbers for the so-called hyperscalers, Google, Amazon, Meta, Microsoft, and the like, thrown Oracle as well, is now going to be in excess of 1 trillion US dollars by the end of this year, and they're upgrading their expectations for spending next year. So who are the principal beneficiaries? Well, first and foremost, and as you know, Eugene, and all of my subscribers know this, I've been a very, very, very big fan of Nvidia way back,
mm,
it's 4 years ago now. And so clearly one of the most amazing beneficiaries. But then, of course, we then get into the whole memory space, memory chips. So who provides memory? It's Micron, it's Samsung, it's SK Hynix. And that's why the emerging markets perform so well, because both SK Hynix and Samsung are such large parts of that
yeah,
emerging market index. And then it went on beyond that. And then people went, hang on a minute, what else do we need? Well, we need power. We need, you had the infrastructure dimension to the AI play. And then you had all the specialist companies. And that's why, Asia, particularly South Korea and Japan, and I've said this for a long time, are a treasure chest of manufacturing and engineering excellence. And many of the companies in Japan and South Korea supply and manufacture the componentry, the hardware that is used in the build out of AI. And so when you think about the picks and shovels, it wasn't just Nvidia, obviously, who make the GPUs, and I still think they're a standout company, incidentally. And my advice, and I'm allowed to give advice like this to all our listeners, every single person listening to this should listen to every single word uttered by Jensen Huang. He is extraordinary. He's a visionary, and every single thing he has said in the last 4 years has come to fruition. Has come to fruition. It is absolutely remarkable. And then you've got great companies like TSMC, as you say, and then you've got all the other companies. So when you see an unprecedented amount of spending, and the world has never seen spending like this being channeled towards companies that are the beneficiaries, there's your investment thesis. And I
Yeah.
think that's the whole AI thing. Then that begs the question. I mean, do I still believe? Am I still an AI believer? Yes, sir, I am. Do I understand that every great investment explosion or phenomenon of the last so many centuries has usually ended in tears? I'm very aware of that. And I'm hypersensitive to that. But on the 18th of August, 2026, do I still believe that the greatest companies in the history of greatest companies, namely Microsoft, Amazon, Google, Meta, and a few others, know what they're doing? I think they do. I think they have a degree of visibility I'm afraid that you and I don't have, Eugene. They
Mm.
are connected into an ecosystem uh, of technology, and they're on the front line. So I listen to all of these companies. I listen very carefully about what their intentions are, what their vision is. And right now, I still am a believer in AI. And obviously, we're seeing the Chinese now stepping up with their frontier models. And that's not necessarily a spanner in the works. It's just yet another dimension to what is an absolutely fascinating investment landscape.
Yeah, absolutely. And you mentioned earlier some of this stuff ending in tears in the past, and I think it's an important point that whenever there's a boom like this, a lot of companies prosper and probably more don't. So, and it's not as easy as one might think to pick out those winners and losers, and that's where active management um, can can also prosper in certain circumstances if they get it right. And I think one of the questions they're all asking themselves as active managers, and we should all be asking ourselves, is how sustainable is this rally, and what happens to the index and to some of these investment themes that have done really well if the AI infrastructure spend starts to slow, which I
Right.
think is one of the concerns that certain areas of the investor community have. So in your, and I think we could all agree, if that investment starts to slow, it will be problematic for some of the picks and shovels company. Not because, I mean, they're still going to make money because slowing is not ending. But when you look at some of the earnings that some of these companies are projecting, and they've not disappointed mostly so far over the last few years. They've usually exceeded a lot of their earnings expectations as a group. But if that, so I guess my question to you is, and then we can move on from this very important topic. Do you think we're anywhere near seeing a slowdown in infrastructure spending in the AI space?
Yeah, I think that's the perfect question. And the way I answer that is I totally understand and respect the so-called second derivative in the rate of change. So we've seen an exponential.
Mm,
Let's just remember what exponential means. It's a rate of change that is accelerating on itself. It's an exponential function. And we've seen an exponential rate of change of increase in spending on building out artificial intelligence. By definition, that rate of change of increase cannot be sustained. Now, you're right. Every time we kind of come to a quarter end, or when we ask these hyperscalers what are they intending to do in the future, they've been upgrading projections on capex. That will come, obviously, at some point, we're going to get a rate of change deceleration, the so-called second derivative. And we're now August 2026. I see sustained expenditure through 2027. I see some leveling off in 2028. And right here and now, in August 26, I actually agree with Jensen Huang, where we have a massive shortage of so-called compute, that
right.
demand outstrips supply because we are only at the doorstep of AI, agentic AI, and the explosion of agentic AI requires a massive increase in computational capacity. So we're agentic AI and then also physical AI. We're talking robotics, we're talking self-drive cars, etc., automobile automation, etc. So there is a massive, massive, massive requirement for more computational capacity. So that's where my head is at the moment. I also understand that the kind of EPS numbers we've seen in the United States for Q2, in terms of actual rate of increase, are obviously unsustainable. And they were very much flattered by unrealized investment gains on these private names such as Anthropic. So Google has a massive, huge unrealized gain on Anthropic and also Microsoft in terms of OpenAI. And those significantly flattered the EPS numbers. But even if you strip them out, we've still seen an extraordinary increase in EPS. And corporate America, when you look at the big 500, which is obviously the S&P, we've seen constant upward revisions to EPS. This is the first year I can recall where EPS projections for the calendar year have been revised up as we progress through the year.
Yeah.
That's the first time it's happened. Usually you start in the upper top left in terms of EPS projections, and as the calendar moves forward, the EPS projections are dropped by Wall Street. This time it's the reverse. Now, I don't think that is necessarily sustainable. So I've got my eyes wide open here. At the same time, I know I'm an AI bull, and I'm on the record, and obviously spoke to you 3-4 years ago, Eugene, about NVIDIA, so on and so forth. And so I'm very aware that someone like myself who kind of puts themselves out there and says, hey, I believe in this, I'm a believer. We don't often look at ourselves in the mirror and say, hang on a minute, open your eyes and be more objective. I respect that accusation. But here and now, I still think there's quite a lot of spending to go.
Okay, that's good to know. And to those of you listening, I guess the message is be careful. There's a lot to consider when investing. And at some point the investment will slow down. But from what you're saying, well, not the investment will slow down, but the rate of increase of investment has to slow down. But it still could be a bit of a runway to go, but it'll be volatile like everything else that booms. All right, let's move on from that and let's turn to geopolitics, which has been impossible to ignore this year. The conflict in and around Iran and the disruption to the Strait of Hormuz pushed oil prices sharply higher in 2026, and they've stayed elevated, although coming back from their peaks, well back from their peaks, but they've stayed elevated and volatile. The market continues to be on edge, and despite many declarations by President Trump, many declarations by Trump, there still seems to be no end in sight. Jonathan, where do you see oil heading from here? Also, you have previously discussed stockpiling of oil supplies, in essence postponing the true impact of the crisis. How do you see all of this playing out?
Right, Eugene,
I only ask you easy questions, JP.
I'll endeavor to be as brief as I can. I can get very, very long-winded on most things, but when it comes to the Middle East, I'm acutely long-winded. So first and foremost, let me just I'm going to make some broad headline kind of observations. Number one, the Islamic Republic of Iran controls the Persian Gulf. Number two, the Islamic Republic of Iran controls the Strait of Hormuz. I've given up counting the number of days since the 28th of February. And essentially, the world has to accept the new reality that Iran, until such time as there's change in Tehran and there's a change in the regime, essentially now controls the Persian Gulf. I have to be a little careful saying some of the things that are in my head on this topic, but I will say just a couple of very, very, very small observations. I lived in the region, as you know, Eugene, for 9 years. I lived in Bahrain, and anyway, I'll tell you right now that the US Fifth Fleet that has been stationed in Bahrain for many, many, many decades is no longer there. The US Navy no longer has control of the Persian Gulf, and that's a fact. They're outside of the Persian Gulf. They're outside. They're in the Gulf of Oman to the east of the Strait of Hormuz, because we now live in a world of asymmetric warfare, where Iran, by definition, in military terms, is inferior, obviously, to the United States. But they have drones, obviously they have missiles, and they have sea mines, etc. So the bottom line is, here we are, and all of the countries in the region are desperately trying to divert oil away from the Strait of Hormuz. and we've got the East-West pipeline that comes out at Yanbu in the Red Sea. The Saudis have increased daily volumes by 4 million a day. And then we've got Fujairah, the Emiratis pumping some stuff around the Strait of Hormuz. We now have the Houthi in play, which is aligned to Iran. We have the Houthi in play in Yemen, and obviously imposed what they said was an embargo on Saudi shipments of crude through the southern end of the Suez Canal, Red Sea, sorry, which is obviously Bab al-Mandeb, which, as you know, in Arabic means the gate of tears. So most shipments are now going up through the Suez to the north, and we know what that does to delays, etc. Bottom line is this: we've got a complete reconfiguration of global energy supply chains and lines. The United States is a principal beneficiary because, of course, they are now a dependable supplier. Every country in Asia is looking to diversify its imports of energy and not be so dependent, obviously, of flows of fuel, crude, and LNG through the Persian Gulf. So, if you've been, I know you do read my report, but I've been highlighting this now for some months.
Yeah.
So the bottom line is, right now the world has fundamentally changed. Oil prices. Unfortunately, the reality is inventories are running down because we're still a net deficit coming out of the Strait. We have been huge beneficiaries of China and the way they've played a role in this energy crisis, because they came into the crisis with 1.4 billion barrels of crude oil in reserve, and they're running that down. South Korea and Japan came in with 210 days of energy reserves, 210 days. And Eugene, as you know, Australia has 30 days. I've written extensively about what I perceive as the undeniable incompetence in Canberra, and that transcends politics. I don't care whether it's Liberal or Labor. This has been a multi-decade of incompetence with regard to our energy security in Australia, because we don't have any energy security, and I won't list all the reasons why. I hope everyone knows by now how we are the largest consumer of diesel on a per capita basis of any country in the world, and we import 90% of our fuel needs. So bottom line is, Iran is in control. That's my view, and I'm willing to debate that with anyone. And Donald Trump is looking for an exit. He's been looking for an exit, I think, about 2 weeks after the war started. He thought it was another Maduro. He thought it might even be an Operation Midnight Hammer. Clearly, it hasn't been. The regime is still in power. The IRGC, Islamic Revolutionary Guard Corps, are now in the ascendancy. I think the regime in Tehran has been emboldened. And in fact, there's been some really interesting reports coming out of Iran in the last 48 hours, intelligence leaks, etc., suggesting the IRGC is in for the long haul, and they're going to prolong this conflict for as long as they can. As you said at the beginning, you said, I don't know how many times Trump has said this war is over and there's been won. Well, it plainly hasn't been won. In fact, we're worse off than we were the day before the conflict began. So, yeah, it's an absolute mess. And that's with a capital M, capital E, capital S, capital S. It's a mess. And I'm afraid the world is going to pay the price, literally and figuratively, through high fuel costs. Now,
it sort of already is. I mean, prices have settled down, but they're 30-40% above oil prices, above what they were before the conflict started.
That's right. And diesel much more. And the big crisis is actually in diesel. If you look at actual diesel futures, that price is eventually going to end up in your petrol pump at your gasoline station. Diesel futures on a year-to-date basis are up 100%. And diesel is in everything.
Yeah. So despite and a lot of the world, as you started talking about earlier, have tried to source other places to buy their fuel from, which is perhaps why oil prices aren't a lot higher than where they are now. But it is definitely a shift. And yeah, from the beginning, I've sort of struggled to see how we could ever go back to how it was before the war. Everyone just took for granted that 20% or roughly 20% of the world's oil supply came from through the Strait of Hormuz, uneventfully. I
Yeah,
don't know if we're
absolutely.
coming back to that after this.
And just a quick thing to add into this, we're not just got as I've written again in my reports recently, it's a forefront energy war now. We've got the Persian Gulf, we've got the Red Sea, we've got the Black Sea, and we've got Ukraine attacks on Russian refineries. So Russia has now stopped all diesel exports, and they're the largest, second largest, nearly the largest, just marginally the second largest diesel exporter in the world. So Ukraine is hitting all the Russian oil infrastructure in the Black Sea, and it's considerable, by the way. Russia has huge energy assets and infrastructure in the Black Sea. So Ukraine is hitting refineries right across Russia, hitting Russian oil infrastructure in the Black Sea. We've got the flows now being limited through the Red Sea and also the Persian Gulf via the Strait of Hormuz. So it's a forefront energy crisis. So it's just getting bigger and bigger. And, we've got the midterms coming up in November. I mean, the American public we know is now saying, "What on earth is this all about? Get the hell out of there!" And I'll finish on this point. I said I lived in the Middle East for 9 years. I had extensive acquaintances and friendships in the U.S. military while I was in the Middle East, and I never thought I would actually say the words that the U.S. Navy has evacuated the Persian Gulf.
Yeah, it's big. All right, and I want to try to move from that to inflation and interest rates. But before we get into that, how much of the current inflation picture do you put down to energy prices versus other factors?
Yeah, these are, have you just got a list of difficult questions today, Eugene? You're usually a lot nicer to me than this. You're usually a lot nicer. I mean, yeah, the inflation story is complicated as well, because we went through we had the COVID thing and that massive kind of structural lift in prices. So there was an absolute lift, prices pretty much globally went up 20, 25, 28, sometimes even 30% from pre-COVID to post-COVID. Then you had the tariffs, and they weren't as inflationary as we first suspected, because Trump basically backpedaled a lot. He started not compromising. What's the word I'm looking for?
Negotiating, compromising, I think is a fair word. Yeah.
Yeah, that's a fair word. And basically lowering the tariffs. And then, of course, we had the Persian War, or the Persian Gulf War, and that has led to a massive energy shock. And as I said, diesel prices going up massively, and diesel's the lifeblood of the economy, and it feeds through into absolutely everything: transportation, agriculture, you name it. It all ends up in the supermarket eventually. And that is still feeding through the system. But at the same time, Eugene, we've got the AI phenomenon, and we've got the whole productivity dividend from AI. And in the United States, the productivity numbers are good. I wish we could say the same for Australia, Eugene. We have woeful productivity. In fact, I know for a fact that the Labour cabinet can't spell the word productivity. So yeah, we've got a problem here in Australia about productivity, but in the United States, they've actually got quite a big productivity dividend beginning to come through the numbers.
Yeah.
But the inflation jigsaw puzzle is really complicated at the moment, because then, of course, in the United States, rent, what we call shelter inflation, and if we draw down within that, owner's equivalent rent, they're decelerating. But when I look in the engine room of inflation, particularly in the United States, I'm seeing higher input costs, and I'm seeing that in the regional Fed surveys. I'm seeing that in the Beige Book, and the Beige Book is a beautiful thing, because they ask thousands and thousands of companies right across the United States, what are you seeing? What are you actually seeing? So we're getting away from all the ridiculously wonky, dodgy government economic data, which I've had a problem with, the employment numbers, the inflation numbers. I think there's a lot of mismeasurement going on. And we're actually going to companies and saying, what are you actually paying for raw materials, chemicals, plastics, whatever, raw ingredients, steel, copper, whatever. And they're saying, no, prices are rising. And yet at the headline level, we've got this kind of benign inflationary situation in the United States, but underneath it, I think there's inflation coming through. Here in Australia, we're a high inflation country now. I say this to all my friends around the world. I now believe that Sydney is the most expensive city in the world. If you add up all the things that people spend money on, I remember in the 80s and 90s going to Tokyo. That was the most expensive city in the world. And after that was Geneva. And so I used to visit those places, and you needed a mortgage, to go and have breakfast at a hotel in Tokyo. I would say now that Sydney is the most expensive city in the world. I mean, Australia is a high inflation nation with zero productivity and negative per capita GDP growth. So it's a real mix, the inflationary scenario. And the other big part of the global inflationary jigsaw puzzle, Eugene, is of course China. Now, China had deflation at a CPI and a producer price level, but that's now turned around. We've now got inflation, and producer prices in China are important. Why? Because China manufactures 35% of all manufactured components and inputs in manufactured goods in the world. So when the costs of those manufactured items are rising, which is what we're seeing in Chinese producer price inflation, not the CPI, the producer prices, then of course that is an inflationary impulse for the rest of the world. So, Eugene, I know I write about inflation a lot. I think about inflation a lot, and I describe my thinking about inflation as looking at a giant jigsaw puzzle. And we've just talked about the manufactured side primarily, but there's so many other factors.
There are absolutely, yeah. And bottom line, high energy prices are inflationary. The difficult part is work, but and you mentioned a lot of other. And the interesting thing about energy price inflation is it's not just the energy; it's all the trickle down,
correct,
impacts of it into supermarket shelves. You knew what I meant. And a range of other things. And then you've got AI and perhaps other technology that has more of a deflationary impact. But it sounds though from from what you were saying that you are concerned about inflation. Which is
I don't think we can. I agree. I agree. Look, I don't think we can just turn our back on inflation and say it's yesterday's problem.
No.
I'm looking at the engine room of inflation, and there's still upward pressure on prices.
So and that's what it looks like to me as well. And it also feels as though if going back, I don't want to go back to energy, but if a lot of countries still have inventory and they haven't run out, as they get closer to running out, the problem becomes worse, right? So it's interesting to see how the world has, perhaps innovated and looked for creative solutions to try to work around what's happening in the Strait of Hormuz. But anyway, we wait and see. Moving on to US interest rates. So the US Federal Reserve held steady again at its July meeting. What made this one interesting, I think, is that three officials actually dissented in favor of a hike, and markets had been pricing in a real chance of a hike, even though I think consensus from the market was that they wouldn't hike, but there was a real chance of it. Even with rates on hold, markets actually reacted as though the Fed should have moved with an increase, and bond yields and mortgage rates pushed higher in the US. So that was interesting. So Jonathan, what's your read on where US rates go from here? And do you think the Fed still has room to cut this year or next year, or do you think the next move is likely up?
I don't think the Fed can cut in 2026.
Yeah.
I changed my mind on the Fed rate, I think 2 days before the meeting, and I put out a special note on in my weekly that I thought Kevin Walsh would raise rates. And I thought it's from a political perspective, it made a lot of sense to raise rates, because you don't want to raise rates in September, which is when the next meeting is, because that's right on the eve of midterm elections. I thought there was sufficient inflationary evidence to warrant a rate hike. And I also was paying a lot of attention to the long end of the market. Now, overnight, Eugene, the 30-year made a new high for this post 2006, 2007 cycle. 5.31% traded on the 30-year bond yield. And so we're beginning to see continued upward pressure on the long end. And Japan made a new, I think it's a 40-year high in terms of the 10-year. UK gilt yields through the roof. France, 15-year highs in terms of long end of the French curve. So we're seeing a lot of upward pressure. And a lot of that is driven by these unsustainable debt levels, but also anxiety around inflation. So the long end of curves is steepening. And I thought Kevin Walsh, it would be prudent for him to be proactive, and that he should raise rates to control the long end of the curve, which is really what's the most important part of the curve. I think Scott Bessent would have been across that in my view, and Stanley Druckenmiller. So Stanley Druckenmiller needs no introduction in this forum. So I thought that, and a lot of the macro hedge fund community was saying, you know what, I think we need to raise rates here to dampen down the long end of the curve. And you saw what happened when he didn't raise rates. The long end of the curve spiked. We saw 13 basis point move in 30-year bond yields. And in fact, the stock market plummeted that day. Anyway, so here and now, I think it's difficult. We're coming into Jackson Hole, obviously, the really important, and this will be Kevin Walsh's first Jackson Hole, of course. And he's going to lay out a kind of monetary policy roadmap. I think he's got a tough needle to thread here. He's got 3 dissents on the committee, as you've highlighted already. I think he's put himself in an unnecessary place. I think he should have got the rate hike out of the way, which is what I was advocating for. And now he's going to have to be thinking, do I do one in September? I think we know that Walsh doesn't really want to raise rates. I think we kind of know that. We know that because he's a believer, as I am, in the productivity side of dividends of AI. He's a huge believer, by the way. He is very immersed in the Silicon Valley AI community, and he philosophically believes in AI as being disinflationary. But now I think it's a 50-50 proposition for September. We saw obviously 2 consecutive, reasonably well-behaved CPI month-on-month reports coming out of the United States, and that's given him a little bit of leeway to not have to raise rates in September. Market probabilities, you know, have dropped significantly from in excess of 65% probability of a rate hike in September. And now we're at about a 38 to 40%. So the market is no longer in the majority.
Yeah.
And so he's probably going to get away with not having to raise rates. And what will happen in the meantime? The long end of the curve goes up. So I think he's
going to be problematic down the track, isn't it?
I think so.
Yeah. Okay. Thank you for that. Closer to home, lots going on. RBA held the cash rate at 4.35% in August. Its second straight hold after 3 hikes earlier in the year. Governor Michelle Bullock has been clear that inflation is still too high and that the board hasn't ruled out another hike, with underlying inflation not expected back at the midpoint of the target until late 2027. Higher oil prices out of the Middle East conflict are feeding into that. Jonathan, do you think the RBA is done for this cycle in terms of hikes, or do you think there's another hike coming? And how worried should we be about inflation getting embedded at these levels, which is always what economists and the market generally is thinking about, largely from a consumer perception point of view, because once that inflation gets embedded into that inflationary perception is embedded throughout the community, it's hard to bring that back. So what are your thoughts on Australia?
Yeah, I'm afraid Australia is kind of in a really, really bad place at the moment. I think we've got stagflationary pressures here in Australia. You know, we've obviously seen we're one of the high inflation nations now, unfortunately. The Australian government has been spending a lot of money, and we've seen that both at the federal and then at the state level as well. We've got a huge problem with energy, massive problem, because we import 90% of it. We've only got 2 refineries, and we're the largest per capita consumer of diesel in the world. So with diesel prices up as much as they are, and they're going to head higher, and I think significantly higher in the next few months here in Australia, you know, the RBA is, I mean, Michelle Bullock's raised rates 3 times. I wouldn't be surprised if she raised rates again. I think we're probably kind of heading towards recession here. I know that we probably need to talk briefly about the property market, but it's going to be really hard for the RBA to raise rates when the economy is as soft as it is. And I just generally, I don't know if you share this sentiment, Eugene, and this is just me talking to people around Australia, whether, you know, in every part of Australia, there's a definite anxiety amongst the business community. Having said that, I've done some traveling to Perth and Adelaide, and they're kind of feeling much better about life. But on the eastern seaboard, particularly Sydney and Melbourne, I think business sentiment in Melbourne is literally in the toilet. Sydney's probably standing in the queue to the bathroom. Queensland's better. Western Australia is still quite robust. And they're a very different economy, Western Australia, very different economy. But yeah, I wouldn't be surprised if Michelle Bullock raises rates again. You all listened to the press conference. She was very, very hawkish in that press conference. And she's basically, you know, got a finger on the trigger. No doubt about it. and she is willing, she is prepared to raise rates again. She doesn't want to, but she will do it if she deems it necessary. And unfortunately, we know that she's not projecting, or the RBA is not projecting, inflation to come back into target till the end of 2027. So I don't know how many years it's going to be above target by then, and they risk losing their credibility.
Yeah, it's a tough spot. I'd hate to be in her shoes at this point in time. I think we're in this position because, and I don't want to go back too far, but I think we had far too long with very low interest rates, which has contributed to where the world's at. But we can't do anything about that now. And in terms of business sentiment, look, I think sentiment amongst financial advice businesses is actually quite good because it's a very different area, and there's supply and demand things in our sector that are very different to others. But certainly in hospitality and retail, and anything around consumer spending, discretionary spending, yeah, just little signs you can see, shops closing and just places not as busy, more sales than usual. These sorts of signs, I do see them. So it'd be interesting to see what happens. Let's talk quickly about the property market and the government's capital gains tax changes. As everybody knows, the 50% CGT discount is being replaced with an inflation index approach from 1 July 2027. There's also going to be tighter rules around negative gearing for established properties. At the same time, as we know, house prices have turned, particularly on the east coast of Australia. Well, I'd say more so Sydney and Melbourne. Brisbane's not so bad, but in any case, the national index is falling, and it's fallen for 3 straight months. It's been one of the steepest run of declines since 2022, particularly with Sydney and Melbourne leading the way down, and even Perth and Brisbane starting to lose momentum. Much of this was, of course, the intent of the government to somewhat stifle escalating house prices. Jonathan, how much of this downturn do you put down to the rate hikes and the tax changes, and how much further do you think prices have to fall? Before you answer, I think it's important to mention that you hear a lot of talk about the wealth effect, which is people feel wealthier because their house prices are going up, and that filters into economic activity and economic growth, and particularly consumer spending. With property prices falling, obviously that it stops that effect, which is one of the reasons why government and central banks are, and perhaps should be, quite sensitive to house price movements. But I also understand why a government might want to get property prices under control. So it's a really interesting spot. But JP, so back to my question, how much of this do you think is causing the downturn, and how much longer do you think this, and how much further do you think this has to go?
I just want to let everyone know, the best advice I can ever give anyone listening to me at this present time is that I've been wrong for so long about Australian real estate. I shouldn't actually be permitted to express an opinion on it. So I will do my best. Clearly, we can see house prices falling, particularly in Sydney and Melbourne. We know volumes, turnover in the real estate market is down considerably. Anecdotally, I've spoken to people in the real estate industry who are saying it's very, very bad. You're right. It's a combination, isn't it? We had 3 rate hikes, and then we had the new legislation coming out from the Labor government. And you put those 2 things together, and that's going to weaken residential house prices. But at the same time, you've got a war in the Persian Gulf. You've got higher fuel costs, particularly diesel. The price of everything is going up. So the consumer has been hit with a really powerful triple whammy. You've had 3 rate hikes. You've had the changes to, CGT, etc., coupled with also Persian Gulf anxiety, and also higher prices at the gas station. They put all that together, clearly, and combined with that, Sydney, obviously, Australia has probably, in my opinion, the highest house prices in the world, particularly when you consider the size of the continent and how few people live here. You have to go to Liechtenstein or Luxembourg or Monaco to see higher house prices. And as we know, those are little tiny places. So, yeah, I mean, I just see house prices falling. I don't know for how long.
Yeah.
That seems to be the way it's going at the moment. But again, I'll say to everyone listening, I've been wrong for so long. on Australian house prices that you should probably ignore. Or actually, no, do this. Do the opposite of anything I say when it comes to Australian real estate.
Well, thanks, JP. Yeah, look, it's been one of the hardest areas to predict, I think, and a lot of it does come down to government policy, central bank policy. There are many variables that feed into what property prices do, but it's an important area because it does feed into a lot of things. I think one of the other issues with property prices is building costs. Building costs have blown out incredibly. So if you're considering building as opposed to buying,
Yeah.
buying looks much more attractive at the moment, I think, than building. I know that from personal experience. Anyway, but it's a watch this space, and again, it's an area to be cautious of. And high inflation. Well, where high inflation pushes up interest rates, that's obviously not a good thing for property. So watching what the central bank does here in Australia and everywhere else certainly matters. We might jump from there to bond yields, which we've talked about already today. So without going over too much old ground, you did touch on Japanese bonds earlier. Long-dated Japanese government bond yields have pushed up to their highest levels since the 90s. And there are early signs of Japanese investors repatriating capital rather than continuing to fund offshore assets like US Treasuries. At the same time, the gap between what the Fed is doing on short-term rates, which we talked about earlier, JP, and where long-term US yields have actually gone, has left plenty of market watchers scratching their heads. So, JP, what's your take on long-term bond yields, on where they go from here? And I think we've sort of discussed on this, and how much of a risk is there that the Japanese repatriation story for global bond markets and asset prices has a more broad impact on the rest of the bond market?
Yeah. So that really leads us down the garden path to the Japanese yen, which right now is really complicated because, of course, we saw for the first time in a very long time joint intervention by the United States and Japan in dollar yen. And that hasn't worked so well, believe it or not. Now, the repatriation trade for the Japanese yen is the kind of ticking time bomb for capital markets, because Japan is the largest creditor nation in the world. They own more of the rest of the world than the world owns of them. And so Scott Bessent, the US Treasury Secretary, is really extremely conscious of that, because he was a hedge fund guy for a long time. So the Bank of Japan right now is at 1%, and they're going to raise rates at the next meeting. But they've got a problem, because the long end, they're losing control of the long end of the Japanese curve. That's a problem. And that's putting upward pressure on all government curves in the UK, France, here in Australia, and obviously in the United States. And if you look at the charts of long-term bond yields right across the world, all of them are breaking higher and making new significant highs. So I'm watching this really carefully. I mean, governments, particularly in the developed world, are in trouble here, because interest burdens, because as they have to refinance all of this debt, and in the United States, Eugene, I think I'm right. In the next 12 months, the United States has to refinance about $8 trillion with a T, $8 trillion of US debt, government debt, and it's going to be with coupons that are a lot higher than when they issued a lot of this debt in the post-COVID period.
Yeah.
So this is a big issue for capital markets. My views. I've been going on about the steepening curve and developed country debt for a while. I'm watching this very carefully. If I see signs that there's going to be a repatriation by Japanese investors, I'll ring the bell very loudly. I'm watching dollar yen. That's your clue. And reversals of the yen carry trade. These are really important moments. So there's a lot of balls that we're juggling in the air at the moment, Eugene, and you've identified one of them right there.
Yeah, it sounds as though there's a lot to be concerned about in the long end of the yield curve at the moment with respect to government bonds. All right, let's now, before we come to a close, we'll spend a minute just talking about Lifespan's managed portfolios and what we've been doing in the last quarter. We've only made a relatively small change over the last quarter, and that was essentially to move an allocation from an Australian bond fund that invested in Australian government fixed-term bonds, mostly fixed-term bonds, into two more diversified bond funds. that will spread their exposure tactically across other sectors, such as, which includes Australian government fixed term bonds, but also floating rate credit, and other sectors, including cash. The basic rationale behind this is, we're not terribly keen on longer term fixed term duration, and we also want to be, because of, you've heard some of the intricacies around the bond market, and we've only talked about some of them today. There's other, the bond market is a highly complex market with many different sectors and structures and whatnot. So we feel as though we want it to be more diversified, and also have that exposure with managers that can move things around a little bit more. Still pretty conservative, low risk managers. Fixed income and bonds is not where we want to have a lot of risk, because they're supposed to be the defensive part of your portfolio. But we want exposure to funds that can be a bit more diverse and a bit more nimble. And we also think there's a lot more value in the high quality floating rate credit space. So when you're worried about bond yields going up, particularly at the long end, you're concerned with longer term fixed coupon bonds, and that's what we're sort of trying. And we've been underweight those investments for a while, but we feel as though, we probably want to be a bit more underweight. So this change will result in the duration of our portfolio being a little bit lower than it was, but also, again, allocating to managers that can move things around depending on how the bond market moves. And if some of the things that we've been talking about today come to fruition, you will need to be nimble in that space. That's the main change. We remain diversified. We remain with perhaps a bias on quality, a little bit underweight growth. We've also, because that we've got lots of exposure to the AI boom, but it's slightly under the benchmark, because we've got concerns about some of those concentration risks, and the possibility that things can change. At some point, it's very hard to time exactly when things change. So it's good, and there are other areas that we didn't really go into today of value out in the marketplace. So yeah, we haven't felt the need to make any drastic changes over the last 3 months, and yeah, that's how we're positioned. JP, anything you wanted to add to that?
No,
No.
I think you've summed it up as you usually do, very, very well.
Well, thank you, Jonathan, again for joining us. It's been a great discussion as always, and great to hear your take on geopolitical events and their impact on markets, amongst the other things that we've talked about. To everybody that's tuned in, thank you again for your support and for listening in. Hope you got something out of this. And if you have any questions regarding anything we have discussed, please do not hesitate to reach out to your Lifespan advisor. And of course, if you don't have an advisor, contact Lifespan directly by visiting our website, and we can help you find one. Thank you again, and all the best.